All right, let's dive into the latest earnings call from grocery giant Kroger because it's revealed a pretty stunning strategic U-turn. They are completely rethinking how groceries get from their shelves to your front door. And the story behind this pivot? It's a fascinating tale of high-tech dreams meeting some very hard reality. And really, it all boils down to this one question. What happens when a multi-billion-dollar bet on robots completely backfires? You see, Kroger went all in on this futuristic vision of automated warehouses. But now, the reality of that bet is forcing a really dramatic and I'm sure costly change of plans. So first up, Kroger's high-tech retreat. Let's take a look at the massive decision to pull the plug on what was supposed to be the absolute cornerstone of their future strategy. Yeah, that sounds dramatic, but it's true. Kroger has officially announced they're closing 3 of their massive automated fulfillment centers. I mean, these were supposed to be the future of grocery delivery. So you're probably asking, why the huge reversal? Well, the reason is surprisingly simple. According to Kroger's own execs, these high-tech warehouses just weren't cutting it. They failed to meet the goals the company had set, both operationally and, more importantly, financially. This failure basically forced them back to the drawing board to create a whole new delivery playbook. So instead of robots in some far-off warehouse, Kroger is now betting on a strategy that's faster, cheaper, and leverages the stores they already have right in your neighborhood. Here's a good way to think about it. The old model was like building one giant, incredibly expensive robotic kitchen to serve an entire region. The new model? It's like realizing you already own hundreds of smaller kitchens, your local stores. It's a major shift from centralized automation to a much more flexible, hybrid approach. So, who's on this new delivery team? Well, Kroger is leaning hard on the experts who've already mastered that tricky last mile. And yeah, we're talking about the big 3. Instacart, DoorDash, and Uber Eats. They're basically plugging their existing stores into these super powerful delivery networks. And is it working? Oh yeah, the early results are actually pretty staggering. In its very first month, the partnership with DoorDash alone fulfilled 1 million orders. That's an incredible start and shows you just how ready customers were for this. And for the customer, the key benefit here is speed. This new model can get you your groceries in as little as 30 minutes. By using local stores, they can meet that growing demand for right now service in a way that giant centralized warehouses simply couldn't touch. But this whole strategic shift isn't just about logistics, it's really about people. So in this next section, we're going to look at what they're calling a tale of 2 shoppers. It's all about understanding the deep divisions in how Americans are shopping for groceries right now. The interim CEO, Ronald Sargent, he put it perfectly. He said all this economic uncertainty is creating a real split in customer behavior. Basically, what a family buys and how they buy it is depending more and more on their income. And here's what that tale of 2 shoppers looks like. On one hand, you have high-income households who are still spending strong, buying premium and organic options. But on the other hand, you have middle and low-income families who are really feeling the pressure. They're making smaller, more frequent trips, hunting for deals, and cutting back on anything that's not an essential. This is the tricky reality Kroger has to navigate. Okay, but here's where it gets really interesting. This isn't just a digital story. In what might seem like a surprising twist, Kroger is betting big on its physical stores. The good old brick-and-mortar grocery store is making a comeback because now those stores are the engines for their entire delivery strategy. So how big is this bet? Well, they're breaking ground on 14 new stores in the 4th quarter alone. And you have to remember, these aren't just places to shop anywhere. They're the local fulfillment hubs that make that 30-minute delivery possible. And they are just getting started. Kroger is planning to ramp up its new store construction by another 30% in 2026. This is a super clear signal that they are committed to making physical stores the absolute core of their entire operation, both for in-person shopping and for digital orders. And they're being really smart about it, too. They're planning these new store hubs in high-growth areas, like Jacksonville, Florida, using one of their most successful brands, Harris Teeter. It's all about building out this new fulfillment network where they know future demand is going to be highest. Okay, so let's get to the bottom line. What's the financial payoff for this big pivot? A $400 million turnaround. This is where we really see the massive impact of these decisions. I mean, the headline number is just stunning. By shutting down the robot warehouses that weren't performing and shifting to this new model, Kroger is projecting a $400 million improvement in its e-commerce operating profit for 2026. To put that into perspective, that $400 million swing is enough to turn their entire e-commerce division from a money-losing operation into a profitable one. They expect to be in the black in just a single year. That is a massive turnaround. So, what are they going to do with all that new profitability? They're planning to reinvest it, creating this really great positive cycle, using the gains to fund lower prices for customers, create better store experiences, invest in technology, and of course, deliver more value back to shareholders. Which brings us to the final lingering question. Kroger has charted a new, decisive course. They've pivoted away from robots to this hybrid model, and they're reinvesting in their stores. The strategy is set, but who is going to be the new CEO to lead it? The search is on, and that is the next big chapter in this story.